You know what's fascinating? While everyone's been watching gold hit record after record, something far more explosive has been building in the silver market. And I'm not talking about some speculative frenzy or Reddit-driven squeeze. I'm talking about a structural supply crisis that's now entering its fifth consecutive year. Fifth year. Let me say that again because it's critical. The silver market has been running a deficit for 5 straight years, and the gap is widening. Now, before you think this is just another precious metals hype piece, let me walk you through exactly what's happening right now. Because what we're witnessing isn't just a shortage. It's a perfect storm of industrial demand, investment buying, and supply constraints that's creating a situation we haven't seen in decades. And the implications? They're staggering. Let's start with the numbers, because they tell a story that most people are completely missing. Global silver demand is sitting at over 1.1 billion ounces. That's billion with a B. Meanwhile, total supply from mining and recycling, it's not even close to meeting that demand. We're talking about a structural deficit that's been draining above-ground inventories year after year. And here's the kicker. This isn't slowing down. It's accelerating. Think about what a structural deficit actually means. It means that every single year, the world is consuming more silver than it's producing. Imagine if you spent more money than you earned year after year. Eventually, your savings run out. That's exactly what's happening with silver inventories. The stockpiles that took decades to build are being systematically drained. And once they're gone, they're gone. But here's where it gets really interesting. The reason for this deficit isn't just one thing. It's a convergence of multiple massive trends all hitting at the same time. And each one of these trends is only getting stronger. First, let's talk about solar panels. Photovoltaic demand for silver just hit another record. We're in the middle of a global energy transition, and solar is at the heart of it. Every solar panel requires silver for its electrical conductivity. There's no substitute that works as well. And governments around the world are mandating renewable energy targets that require billions of solar panels to be manufactured over the next decade. China alone is installing solar capacity at a pace that would have seemed impossible just 5 years ago. Europe is racing to energy independence. The United States is pouring hundreds of billions into green energy infrastructure. All of it requires silver. And here's what most people don't realize. As solar technology improves and becomes more efficient, it doesn't use less silver. In many cases, it uses more. The newer, high-efficiency panels require more silver per panel to achieve those efficiency gains. So we're not just talking about more panels. We're talking about more silver per panel, multiplied by exponential growth in panel production. Then there's the electric vehicle revolution. Every EV uses significantly more silver than a traditional combustion engine vehicle. We're talking about electrical contacts, circuit boards, charging infrastructure. Silver is the most conductive metal on Earth. When you're dealing with high-voltage electrical systems, you need the best conductor available, and that's silver. Now multiply that by the fact that global EV sales are projected to grow from millions to tens of millions to eventually hundreds of millions of vehicles. The silver required for this transition is mind-boggling. But it's not just EVs. It's the entire electrical grid transformation that's required to support them. Charging stations, grid upgrades, smart grid technology, energy storage systems. All of it is silver-intensive. We're essentially rebuilding the electrical infrastructure of the developed world, and silver is a critical component of every single piece of that puzzle. Now, let's talk about something that's flying completely under the radar: artificial intelligence. You might be wondering what AI has to do with silver. Everything. AI requires massive data centers. These data centers are filled with servers, and those servers are packed with silver-containing components. The explosion in AI computing power we're seeing right now is driving unprecedented demand for data center construction. And it's not slowing down. Every major tech company is in an arms race to build more AI capacity. Microsoft, Google, Amazon, Meta, they're all spending tens of billions on data center infrastructure. And every single one of those facilities requires silver. Think about the scale we're talking about. A single large data center can require tons of silver. And we're not building 1 or 2 data centers. We're building hundreds of them. The AI revolution is still in its early innings, and it's already creating silver demand that wasn't even on anyone's radar 5 years ago. But here's where the supply side of the equation gets really problematic. Silver mining isn't like flipping a switch. You can't just decide to produce more silver because the price goes up. Most silver, about 70% of it, comes as a byproduct of mining other metals like copper, lead, and zinc. That means silver production is largely dependent on the economics of those other metals. Even if silver prices double, if copper prices are low, those mines might not be economical to operate. So silver supply is constrained by factors that have nothing to do with silver demand. And the primary silver mines that do exist? They're facing their own challenges. Ore grades are declining. The easy silver has already been mined. New discoveries are rare and take years, sometimes decades, to bring into production. Environmental regulations are getting stricter. Labor costs are rising. Energy costs are rising. The cost to produce an ounce of silver has been climbing steadily, and many mines are barely profitable at current prices. Let me paint you a picture of what this means. Imagine you're running a silver mine. Your costs keep going up. Your ore grades keep going down, meaning you have to process more rock to get the same amount of silver. You need to invest hundreds of millions in new equipment and infrastructure just to maintain current production levels. And the price of silver? It's been relatively flat for years, not keeping pace with your rising costs. What do? You cut back on exploration. You delay expansion projects. You focus on the highest grade deposits and leave the rest in the ground. That's exactly what's been happening across the industry. Now, here's where it gets even more interesting. While industrial demand is soaring and supply is constrained, investment demand is starting to wake up. For years, investors largely ignored silver. Gold got all the attention. But that's changing. Silver ETFs are seeing inflows again. Physical silver dealers are reporting shortages of popular products. Premiums on silver coins and bars have been elevated for months. Why? Because smart money is starting to recognize what's coming. Let's talk about the gold to silver ratio for a moment because it's telling us something crucial. Historically, this ratio has averaged somewhere between 40 and 60 ounces of silver to 1 ounce of gold. Right now, even after silver's recent gains, the ratio is still elevated compared to historical norms. But here's the thing. When silver moves, it doesn't move gradually. It explodes. In 1979 and 1980, silver went from around $5 an ounce to $50 in a matter of months. In 2011, it went from around $17 to nearly $50 in less than a year. Silver doesn't trend. It erupts. And the setup right now looks eerily similar to those previous explosive moves. You've got a structural supply deficit. You've got rising industrial demand that's not price sensitive, meaning industries will pay whatever they have to pay because they need the silver for production. You've got declining inventories. And you've got investment demand that's just starting to accelerate. All the ingredients are there. But there's another factor that most people aren't considering: the monetary aspect. Central banks around the world have been accumulating gold at record pace. Why? Because they're diversifying away from dollar-denominated assets. They're preparing for a world where the dollar isn't the undisputed global reserve currency. And while central banks focus on gold, private investors and institutions are starting to look at silver as gold's more affordable cousin. Silver has a 5,000-year history as money. It's been used as currency by more civilizations than gold. And at current prices, it's accessible to a much broader range of investors. Think about what happens when the general public starts to catch on to this story. Right now, most people have no idea there's a silver supply crisis. They don't know about the structural deficits. They don't understand the industrial demand dynamics. But when silver starts making headlines, when the price starts moving in a way that captures attention, that's when the real buying pressure begins. And unlike gold, where there are massive above-ground stockpiles, silver inventories are far more limited. The available supply for investment is actually quite small relative to the size of global financial markets. Let me give you some perspective on this. The entire silver market, all the silver mined in a year, is worth maybe $30 billion at current prices. That's less than the market cap of many individual companies. It's a rounding error in global financial markets. Now imagine what happens if even a small percentage of global investment capital decides to allocate to silver. The market is simply too small to absorb that kind of buying pressure without massive price appreciation. And here's something that should concern anyone paying attention. The paper silver market is enormous compared to the physical market. Futures contracts, ETFs, derivatives, there's far more silver traded on paper than actually exists in physical form. This works fine as long as everyone's content to trade paper claims. But what happens when people start demanding physical delivery? We've already seen stress in the physical market. Premiums have been elevated. Delivery delays have been reported. The COMEX, the major futures exchange for silver, has seen its inventories decline significantly. At some point, the paper market and the physical market have to reconcile. And when they do, the price adjustment could be violent. Now, I want to take a quick aside here because this is relevant to a lot of people watching. If you're sitting on retirement accounts, IRAs, 401ks, and you're concerned about the dollar's purchasing power, about inflation, about the stability of the financial system, there are ways to get physical precious metals into those accounts. I put together a free guide on how gold IRAs work, how you can move funds from existing retirement accounts into physical gold and silver without tax penalties. It's in the description below. If you've got 100,000 or more in retirement savings, it's worth understanding your options. Just something to consider as we're talking about these massive structural shifts in the metals markets. All right, back to the silver story because there's more to unpack here. Let's talk about what's happening in the physical market right now. Refineries are running at capacity. Mints are struggling to keep up with demand for coins and bars. The U.S. Mint has had to ration silver eagles multiple times in recent years. The Royal Canadian Mint, the Perth Mint, they've all faced similar challenges. This isn't normal. This is what happens when physical demand exceeds the available supply of refined product. And here's what's particularly interesting. This is happening while silver prices are still relatively subdued. Imagine what happens when prices start rising significantly. That's when the real scramble begins. That's when industrial users start panic buying to secure supply. That's when investors pile in, afraid of missing the move. That's when the shortage goes from a technical supply-demand imbalance to a full-blown crisis. Let me tell you about something that happened in the palladium market a few years ago, because it's instructive. Palladium is used primarily in catalytic converters for vehicles. For years, the market was relatively balanced. Then, a combination of factors hit. Stricter emissions standards increased demand, supply from Russia became uncertain due to geopolitical tensions, and inventories were drawn down. The price of palladium went from around $500 an ounce to over $3,000 an ounce in just a few years. It more than sextupled. Why? Because when you have inelastic industrial demand, meeting constrained supply, price becomes almost irrelevant. Industries have to have the metal to keep production running, so they pay whatever it takes. Silver is in a similar position, but the market is even tighter. And unlike palladium, which is purely industrial, silver has that monetary component. It has investment demand on top of industrial demand. That's a much more explosive combination. Now let's talk about what the smart money is doing, because that's always instructive. Major mining companies are starting to highlight their silver assets. Streaming companies, which provide upfront capital to miners in exchange for future metal production at fixed prices, are increasingly focused on silver deals. Why? Because they see what's coming. They understand the supply-demand dynamics, and they're positioning themselves to benefit from what they believe will be a significant repricing of silver. Billionaire investors have been accumulating silver positions. Now, they don't advertise this. You won't see press releases. But if you dig through 13F filings, if you pay attention to what mining stocks they're buying, if you listen to what they say in interviews, the message is clear. Silver is deeply undervalued relative to its fundamentals. And it's not just financial investors. Industrial users are starting to get nervous. Companies that use silver in manufacturing are looking at the supply situation and realizing they need to secure long-term supply agreements. They're willing to pay premiums to lock in supply because they understand that if they can't get silver, their production lines shut down. That's an existential threat to their business. So they're competing with investors for available supply. And that competition is only going to intensify. Here's another angle that's not getting enough attention: the geopolitical dimension. Silver mining is concentrated in a relatively small number of countries. Mexico, Peru, China, these are major producers. What happens if there are political disruptions? What happens if resource nationalism increases and countries decide to restrict exports? What happens if trade tensions escalate and supply chains are disrupted? These aren't hypothetical concerns. We've seen resource nationalism increase across the developing world. We've seen supply chains prove far more fragile than anyone realized. And silver, being critical to so many industries, becomes a strategic resource. Imagine you're a country that's a major silver producer. You look at the global supply situation. You see that silver is essential for the energy transition, for electronics, for defense applications. Do you keep exporting all your silver at current prices? Or do you start thinking about strategic reserves, about keeping more production domestic, about using silver as a geopolitical lever? These are the kinds of questions governments are starting to ask. And the answers could have profound implications for global silver supply. Let's talk about the recycling side of the equation because some people point to recycling as a solution to supply constraints. And yes, recycling does provide some supply. But here's the reality. Most silver is used in applications where it's not economically recoverable. It's used in tiny amounts in electronics, in solar panels, in medical applications. The cost to recover that silver exceeds the value of the silver itself. So while recycling helps at the margin, it's not going to solve a structural deficit. The silver that's easiest to recycle, like old jewelry and silverware, has already been recycled. What's left is increasingly difficult and expensive to recover. And here's something that should concern anyone thinking about the long term. We're using silver faster than we're discovering new deposits. Exploration budgets have been cut. The number of significant new silver discoveries has declined dramatically. The projects that are in development are increasingly complex, increasingly expensive, and increasingly located in challenging jurisdictions. The easy silver is gone. What's left requires higher prices to justify extraction. But the market hasn't priced that in yet. Now, let's connect all these dots. You've got industrial demand that's growing exponentially due to the energy transition, electrification, and digitalization. You've got supply that's constrained by geological, economic, and geopolitical factors. You've got inventories that have been drawn down for 5 consecutive years. You've got a paper market that's far larger than the physical market. You've got smart money accumulating positions. You've got industrial users getting nervous about supply. And you've got a general public that's completely unaware of any of this. What happens next? Well, if history is any guide, silver doesn't move in a straight line. It consolidates, it builds a base, and then it explodes higher in a move that catches almost everyone off guard. The people who position themselves before that move, who understand the fundamentals, who recognize the setup, they're the ones who benefit. The people who wait until silver is making headlines, until everyone's talking about it, they're the ones who buy at the top and then panic when there's a correction. The thing about supply-demand imbalances is that they can persist for longer than seems rational. Markets can stay irrational longer than you can stay solvent, as the saying goes. But eventually, reality asserts itself. Eventually, prices have to adjust to reflect the underlying fundamentals. And when that adjustment happens in a market as small and as tight as silver, the moves can be breathtaking. Think about what a doubling of the silver price would mean. For a mining company with significant silver production, it could mean the difference between marginal profitability and massive cash flow. For an investor who positioned early, it could mean substantial gains. But more importantly, it would signal that the market is finally waking up to the supply crisis. And that's when things get really interesting, because a doubling might just be the beginning. Let me give you another historical parallel. In the 1970s, silver went from around $2 an ounce to $50 an ounce. That's a 25-fold increase. Now, I'm not predicting that kind of move, but I want you to understand what's possible when you have a small market, a supply shortage, and a rush of buying pressure. The moves in silver can be far more dramatic than in larger markets because there's simply not enough supply to meet surging demand. And here's what's different about this setup compared to previous silver bull markets. The industrial demand component is far larger and far more critical. In the 1970s, silver's move was largely driven by investment demand and monetary concerns. Today, you have that same potential for investment demand, but you also have massive industrial demand that's not going away. Solar panels don't stop needing silver because the price goes up. EVs don't stop needing silver because the price goes up. Data centers don't stop needing silver because the price goes up. That industrial demand provides a floor, a baseline level of buying that has to happen regardless of price. So you've got price-insensitive industrial demand meeting price-sensitive investment demand in a market with constrained supply and declining inventories. That's not a recipe for a modest price increase. That's a recipe for a potential moonshot. Now, I want to be clear about something. I'm not telling you what to do with your money. I'm not giving financial advice. What I'm doing is laying out the facts, the data, the supply-demand dynamics that are playing out in real time. You have to make your own decisions based on your own situation, your own risk tolerance, your own investment goals. But I will say this. Ignoring what's happening in the silver market right now would be a mistake. Whether you decide to act on it or not, you should at least understand what's unfolding. Because here's the thing. Opportunities like this don't come around often. Most of the time, markets are relatively efficient. Prices reflect available information. But occasionally, you get situations where there's a disconnect between price and fundamentals, where the market hasn't caught up to reality, where patient, informed investors can position themselves ahead of a major move. The silver market right now appears to be one of those situations, and the risk-reward is compelling. If I'm wrong, if somehow supply magically increases or demand collapses, silver might drift lower or stay flat. But if the fundamentals play out the way they appear to be heading, if the supply deficit continues, if industrial demand keeps growing, if investment demand accelerates, the upside potential is enormous. That's an asymmetric bet. Limited downside, substantial upside. Let me leave you with this thought. The global economy is going through a massive transformation. We're transitioning from fossil fuels to renewable energy. We're electrifying transportation. We're digitizing everything. We're building out AI infrastructure. All of these trends require massive amounts of silver. At the same time, silver supply is constrained and inventories are declining. This isn't a temporary imbalance. This is a structural shift that's going to play out over years, possibly decades. The question isn't whether silver prices will have to rise to reflect these fundamentals. The question is when and by how much. And the answer to that question could determine whether you're positioned to benefit from one of the most significant commodity moves of this decade, or whether you're watching from the sidelines wishing you'd paid attention when the signs were all there. The silver squeeze isn't coming. It's already here. It's been building for 5 years, and it's now going global as the world wakes up to the reality of the supply situation. The smart money is positioning. Industrial users are scrambling. And the general public? They're still completely in the dark. But that won't last forever. And when the crowd finally catches on, when silver starts making headlines, when the price starts moving in a way that captures attention, that's when the real move begins. So pay attention. Do your research. Understand what's happening. Because what we're witnessing in the silver market right now is the kind of setup that comes along once in a generation. And the people who recognize it early, who position themselves before the crowd, they're the ones who benefit when the inevitable repricing occurs. The silver squeeze is real, it's global, and it's accelerating. Don't miss what could be one of the most significant investment opportunities of the decade.